This class is going to be going through assignment 2 for RSK4805 2022. I'm going to be taking you through the assignment questions and some important things you need to note with regards to calculations, the areas to focus on in the prescribed textbook, and how to approach some of these questions, right? So I'm under the assumption that the questions are the same for everyone, but I remember there's a student who contacted me who said that some of the questions are different, like that student had different questions. So I'll wait for feedback from you and the others as to whether the questions are different or they are the same. Some of them might be overlapping, and then some of them might be different, because sometimes you'll find that some assignments, for example, the first assignment had different questions for everyone. And then you might find that for some assignments, like the third assignment that I've seen, the questions are the same for everyone. So what we'll have to do, we'll have to see based on feedback whether the questions are the same or different for everyone. But from what I've heard, questions for assignment 2 might be different. Some of them might overlap and some might be different. So if we manage to finish the ones that I gave you solutions for quickly, we can be able to go through others, and whatever I cover in this class might be able to help you if you have different questions. So that's the first and important point. And then, like I said earlier, if you have any questions, you're free to unmute yourself. I'm not sure if that will be possible. You can raise your hand. I know there's an option in Zoom where a person can raise their hand if they have a question to ask. And then if you are also not able to communicate with me through raising your hand or unmuting yourself, you can quickly send me a WhatsApp message, and then I can respond to you or try to unmute you and so forth. Okay, so we can get started. So assignment 2 for RSK4805 consists of 7 questions. It's got 7 questions. And then from what I saw, these 7 questions for this particular assignment I'm going to be taking you through, the questions are mainly based on chapters 5, chapter 6, chapter 5, chapter 7, chapter 8, and chapter 9. Okay, the questions are mostly based on these chapters, right? So I'm going to be referring to those chapters as we go through the assignment and just highlighting some of the important things you need to know that might not have been asked in the assignment or in general. So we'll start with question 1, right? I'll read out question 1, and then I'll give you some background. I'll also refer to where you can get more information with regards to helping you cover question 1, and then I'll explain how to approach the question. Okay. So this particular question says that we've got a portfolio, right? A portfolio A, which consists of a 1-year 0 coupon bond with a face value of $3,000, and a 10-year 0 coupon bond with a face value of $7,000, right? So that's portfolio A. And then we've also got another portfolio B, which consists of a 5.95 year 0 coupon bond with a face value of $4,500. And then we're told that the current yield on all bonds is 10% per annum, continuously compounded, right? And then we are asked a number of questions. The first question we are asked is to determine the value of portfolio B, right? And then the second question we are asked is what will happen if interest rates increase by 3.5%? Would the value of portfolio B increase or decrease? And then the last question is, if there is a change of 3.5% per annum, an increase in the yield of 3.5% per annum, by what amount will the value of portfolio B change by? Okay. Right, so some background first. before we answer this particular question, just some background. With regards to this question, you'll find background and information on this question in chapter 9 of your prescribed textbook. You'll find background on this particular question in chapter 9 of your prescribed textbook. Likewise, if you refer to the notes that I gave you that you can access on the website that I gave you a link to, you can also find notes with regards to what we want to cover in this particular question, right? Chapter 9. So what this particular question is teaching me, this particular question is examining if you understand the concept of interest rate risk. So I just want to give you some background before I answer the question. The question is just, it's an assignment question testing to see if you understand the concept of interest rate risk. Now, remember, when we talk about interest rate risk, right? Interest rate risk is the risk that the price of a bond changes. It's the risk that the price of a bond changes due to changes in interest rates. Okay, so when we talk about interest rate risk, it's the risk that the price of a bond or the price of a bond portfolio changes, right? It's the risk that the price of a bond or the price of a bond portfolio changes, the price changes due to changes in interest rates. So if you hold a portfolio of bonds, right, or you hold a particular bond, you are always exposed to risk, right, which we call interest rate risk. And this is the risk that the price of your bond or the price of your bond portfolio will change due to changes in interest rates. Okay, so whenever interest rates change, the price of a bond will change. Whenever interest rates change, the price of a bond portfolio will change. Remember, when we talk about a portfolio, we're just talking about a collection of different assets. So in this case, when we talk about a bond portfolio, we're just talking about a collection of bonds, a collection of different bonds. So whenever interest rates change, your portfolio, the price of your portfolio of bonds will change, or the price of a particular bond will change. And then we have an inverse relationship. Or what we call an indirect relationship between the price of a bond or the price of a bond portfolio.
So the reason behind this is that when it comes to bonds, bonds pay fixed coupon payments, right? So when you're getting a fixed coupon payment, changes in interest rates, can affect the attractiveness of your coupon payments. For example, if you're receiving 10% fixed coupon payments and then interest rates go up, let's say interest rates go up to 12%, right? You'll be at a disadvantage because you'll be receiving fixed 10% coupon payments for a certain amount of time, whilst everyone else will be receiving 12% coupon payments because interest rates have gone up. And because of that, interest rates going up and everyone else now receiving something higher compared to what you're receiving, that rise in interest rates will lead to a fall in the price of the bond that you hold, because it will be less attractive because everyone else will be getting 12%, whereas you're getting a fixed 10%. And the same applies if interest rates go down. Let's say interest rates go down to 8%, right? You'll be at an advantage because you'll be receiving a fixed 10% on your bond investment for a certain amount of time, whilst everyone else in the market will now be getting 8%. So that will make your bonds more attractive, and it will mean that the price will actually go up. So that's why there's an inverse relationship between the price of a bond and changes in interest rates. And then lastly, before I touch on that question, I'm just giving you some background. We can measure the interest rate risk. We can measure the interest rate risk of a bond using a measure known as duration. There's a measure known as duration, which can tell us the interest rate risk of a bond. And basically what duration tells us the percentage change in the price of a bond for a 1% change in interest rates. So for example, if someone says the duration of our bond is 8, right? That person is telling us that if interest rates change by 1%, the value of our bond will change by 8%. The price of our bond or the price of our bond portfolio will change by 8%. That's what duration tells us. If someone tells us that our duration is 8, for example, they are telling us that if interest rates change by 1%, the percentage change in the value of our bond or our bond portfolio will be 8%. Okay, and we know that if interest rates are going up by 1%, then the value of our bond portfolio is falling by 8%. And if interest rates are going down by 1%, then the value of our bond portfolio is rising by 8%. So with regards to interest rate risk and bonds, you need to firstly understand that inverse relationship that I've been speaking about all along. You need to understand that inverse relationship between bond prices and interest rates. You need to understand this, right? And then you also need to be able to calculate the value of a bond or a bond portfolio, right? And then you also need to be able to calculate duration, the duration of a bond or a bond portfolio. And then you also need to be able to calculate the change in the price of a bond for changes in interest rates. The change in the price of a bond for changes in interest rates. Now, all of this is covered in chapter 9, including the classes I've given you access to, right? But for this particular question you were given in the assignment, the question was just focusing on these three particular areas, right? Firstly, we are going to be asked to explain the relationship between changes in interest rates and bond prices. We are also going to be asked to calculate the value of a bond or a bond portfolio. And then we're going to be asked to calculate the change in the price of a bond for changes in interest rates. We were not asked to calculate duration, right? But you might get questions where you're asked to calculate duration. So it's also important to be able to calculate duration, okay? So let's go to this particular question and let's answer it now that we have some background with regards to bonds, what bonds are in the context of interest rate risk, and what we mean by duration. So let's look at this question. Okay. So the first thing we were asked to do with this particular question, we were asked to calculate the value of a particular bond portfolio, right? And we were told that the portfolio that we wanted to calculate the value of is portfolio B. And portfolio B consists of a 5.95% zero coupon bond with a face value of 4,500 and a current yield of 10%. Okay. Now, when you want to calculate the value of a bond, right? A zero coupon bond, when you want to calculate the value of a zero coupon bond, you simply take the face value of that zero coupon bond, and then you multiply it by the exponential to the power minus of the term to maturity in years multiplied by your yield. Okay, so I'll repeat that. If you want to calculate the value of a zero coupon bond, you simply take the face value of the zero coupon bond multiplied by the exponential of the product between the term to maturity of the bond and the yield or the interest rate. Okay, so what we are doing here, we are basically just discounting the face value of the bond. We're just discounting the face value of the bond using what we call continuous compounding. That's another way of explaining what we are doing here, right? We are simply discounting the face value of the bond using continuous compounding. And we have been told here that the yield on the bonds is continuous compounding. So you'll find that for this module, for the bond calculations, like if you refer to your prescribed textbook and you look at chapter 9, you'll find that the calculations with regards to bonds always involve continuous compounding. Like when we're determining the value of a bond, or even when we're doing duration calculations, the calculations will always involve exponentials. Like you'll use exponential values when it comes to calculating bond prices and duration calculations. It will mostly be exponential values, like we use continuous compounding rather than discrete compounding when we're calculating the prices of bonds in this particular module. I was just trying to find, you see, for example, we discount, we'll always use exponentials. I know in some other modules, if you've done finance before, they use what we call discrete compounding. But for the purposes of RSK4805, when we're dealing with any calculations to do with bonds, whether duration, you see there'll be exponentials. So we'll use continuously compounded rates for any of our calculations involving bonds. So that's important. So for this particular question, when we want to determine the value of a bond, right, a zero coupon bond, we just simply discount the face value using continuous compounding. So in this particular case, we just take 4,500, which is our face value, and then the bond matures in 5.95 years, right? And we have a current yield, which is continuously compounded of 0.10. So we just have to do this calculation to give us the value of the bond, right? So it's a simple calculation, but a lot of students struggle with this particular part when it comes to their calculators, right? So to make this a bit easier for you, what you can do, you can use your scientific calculator. So I'm just going to put a version of a scientific calculator up here just to illustrate how you would do this calculation, for example. So I have a version of a scientific calculator here. Yours might be slightly different. So here we would say 4,500 multiplied by, and then usually you'll find that your exponential is by the ln pattern, the natural logarithm pattern. That's where you'll find your exponential. So ours is at the top there. So we have to activate the second function or the shift button such that we bring up the exponential, and then you'll see that it shows up there. And then I advise you to open brackets, then to put your minus. Usually there'll be a plus minus button or a separate minus button, not this one, which is this minus button. Then you say 5.95 multiplied by our continuously compounded yield. And then we get 2482.013. So that is the value of our bond, right? So that's how you would do that calculation. So the input that you would put on your calculator would be different. Some people have Sharp calculators, others have Casio calculators. So it depends, right? So that's how we would calculate the value of our portfolio, right? So some important things to note before I move on to the rest of the question, right? The first important thing to note is that this is a zero coupon bond. This is a zero coupon bond. With a zero coupon bond, you don't have any coupon payments. There are no coupon payments. This is really important. So the only value you are discounting, the only value that you are discounting is the face value that you will receive back from your investment under a certain number of years, right? So it becomes easy to calculate the value of a bond when you just have a zero coupon bond, right? But it's different if you have a case like this here in the prescribed textbook where you have a coupon paying bond. So this is an example of how to determine the price of a coupon paying bond. This bond in particular had, let me make it simple. Okay, let me make it a bit simple. Unlike the example that they've given here, I just want to give you something simple. Let's say we have a 3-year bond, right? And let's say this bond pays coupons with a coupon rate of 5%. And let's say our par value, is 1,000 Rand, right? And then let's say the yield continuously compounded is 10%, right? So with this particular bond, rather than just receiving the principal value after a certain number of years and no coupons, with this particular bond, you will be receiving coupons, right? At a coupon rate of 5%. So basically, if you invest your money in this bond, what will happen is that, let's say 5% of 1,000, we get 50. So this is going to be your coupon payment. If you invest in this particular bond, right, which has a coupon payment, we are saying that you lend your money to a business or to the government or to some organization. And then what will happen is that they will pay you 50 Rand at the end of the first year, right? Based on the coupon rate times the par value, giving us a coupon payment of 50. Then they'll pay you 50 Rand again at the end of the second year. And then at the end of the third year, they'll pay you 50 Rand again as your interest payment, plus they will pay back your par value. So these will be the cash flows associated with a coupon paying bond over 3 years. Compare that with the zero coupon bond we were talking about. With the zero coupon bond, we were simply saying that you lend your money to a government or to a business or some organization, and then after 5.95 years, that organization will just pay you back 4,500. There'll be no coupons. There'll be no coupons over the life of the bond. So this is a zero coupon bond. It's got no coupons. You just invest your money, maybe you give them 3,000 Rand, and then after 5.95 years, they give you back 4,500 Rand. Whereas with a coupon paying bond, you'll be receiving interest payments up until maturity. So now, when it comes to determining the value of a coupon paying bond, it's not just a matter of discounting the face value. You now have more cash flows to discount. You first have to discount the first cash flow that you're going to receive after 1 year, and you discount that at an interest rate of 10%. Plus, you then have to discount the second cash flow that you'll receive at time 2, also at a discount of 10 Rand. And then you also have to discount the final cash flow that you'll receive, right, at the end of 3 years. So with a coupon paying bond, if you want to determine the price of a coupon paying bond, you have to discount each of the cash flows that you're going to be receiving at the end of each year. The first cash flow at the end of year 1, second cash flow at the end of year 2, plus the third cash flow at the end of year 3. And then you add them up, and then that gives you the value of your bond. So it's important to note that when you're determining the value of a zero coupon bond, you're just looking at one cash flow that you need to discount. Whereas if you're determining the value of a coupon paying bond, you actually need to understand when you're receiving your coupon payments and the amounts of the coupon payments. And then you need to discount all of those depending on the time at which the cash flows are received. And then you can add them up, and that gives you the price of the bond. Okay, so that's important. There are a lot of those examples in the textbook and even in the other classes if you've been going through them in the past memos and past assignments. So that's the first important thing I wanted you to note. And then lastly, this particular portfolio that we were told about, portfolio B, it just consists of one bond. It just consists of one bond. Other portfolios consist of 2 bonds or 3 bonds. For example, portfolio A consists of a 1-year zero coupon bond with a face value of 3,000 and a 10-year zero coupon bond with a face value of 7,000. So if you are asked to determine the value of portfolio A, if you are asked to determine the value of portfolio A, what you would need to do in this particular question, you would first need to determine the value of the first bond. You would first need to determine the value of the first bond, whereby we just take the face value minus the maturity after 1 year times our current yield. So we would take the value of the first bond plus the value of the second bond, right? So if you have a portfolio which matures in 10 years, if you have a portfolio with more than one bond, you need to determine the value of each of the bonds in the portfolio, then you add them up to get the total value of the portfolio. Okay. So those were just some important concepts I was taking you through determining the value of a bond portfolio. I think that I've covered it extensively. It's now just a matter of practice. We have coupon paying bonds, we have zero coupon bonds. Zero coupon bonds, you're just discounting one cash flow. Coupon paying bonds, you're discounting a number of cash flows. And it's always important to draw a timeline to help you to understand when the cash flows are being received and how to discount them. And then lastly, when we look at a portfolio of bonds, some portfolio of bonds just consist of one bond, right? Like portfolio B, whereas others consist of 2 or more bonds. So if you want to get the total value of a portfolio of bonds, you have to determine the value of each bond in the portfolio. Then you have to add up the values to give you the total, right? Then the next part of the question, we covered a lot of theory with regards to this. Here we are told that what will happen? Let's say interest rates increase by 3.5%. Let's say interest rates go up. Sorry, does anyone have a question?
Yes.
Yes.
Yeah, when you talk about value of portfolio A and you said we add them together, the total of portfolio A, does it come at face value when we're calculating it, or is just an answer? Because my assignment say calculate the value of portfolio A. So do I have to get a total first and then use this formula that you used here when you calculate the value of portfolio B? I'm getting confused there.
Okay, the value of portfolio A is just 3,000 E minus 1 times 0.1. This is the value of the first bond in the portfolio. And then the value of the second bond, it's E minus 10 times 0.10, right? So let me just, so we can do this on a calculator. We can do this on a calculator. I'll just do it now. So on your calculator, you would simply just go to your calculator. make sure you clear your calculator first. It's always important to make sure your calculator is cleared. And then we would just say 3,000. So it depends with your calculator here. Then you say times second function. So you look where there's ln, there'll be an ex. For some calculators, you press second function, others you press shift, it depends. And then I'll say open bracket, and then minus 1 multiplied by 0.10, right? So this is the first bond, right? So you can even write that answer down, or you can just continue. It depends on the type of calculator you have. For some people,
yeah, I got the right answer.
Yeah, you can write this answer down, or you can just continue depending on the type of calculator you have. And then 7,000 exponential. So the second one matures in 10 years. And it's also got a 10, we were working with 10% interest. So this will be the final answer. But if you're not comfortable with your calculator, you can do this calculation first, then you can write it down. Then you can clear your calculator. Then you can do this calculation, right? Write it down, then you can add them together. But if you're comfortable with your calculator, you can do everything at once. The thing is, people have different calculators. Some have Casio, some have Sharp. So it depends. Yeah. If you're not comfortable, you can do it one by one. Do you get that? Like you can do the first part, which is what I showed you, right? And then after doing the first part, you can then do the second part, right? You can do the second part by itself. The second part by itself is 2575.16. And then the first part by itself is 2714.51. Then you can add them together. You'll still get the same answer.
Okay, yeah, I got you.
Okay, sure.
Thank you.
Okay. So that's how we would determine the value of portfolio B or A, right? And then remember, like I was saying, there's an inverse relationship between interest rates and the value of a bond portfolio, right? When interest rates go up, like I've been saying when the lesson started, when interest rates go up, the value of a bond or a bond portfolio goes down. There's an inverse relationship, right? When interest rates go up, the value of a bond or a bond portfolio goes down. And likewise, when interest rates go down, the value of a bond or a bond portfolio goes up. Okay. And we explained why that happens. We said that bonds are giving you a fixed rate of return, a fixed interest. So when interest rates are going up, everyone else is starting to get higher interest rates, whereas you're getting a fixed interest rate. So that reduces the value of the bond. That's why it goes down when interest rates go up. And likewise, when interest rates go down, a bond gives you a fixed interest rate of return, right? So when interest rates go down, everyone else in the market will be getting a lower return on their bond investment whilst you're getting something higher. So that will increase the attractiveness of your bond, and the price of your bond or your bond portfolio will go up. So the next question is a bit straightforward. We're told that if interest rates increase by 3.5%, what will happen to the value of our portfolio B? Portfolio B will decrease in value. The same will happen to portfolio A. Any bond portfolio or any bond at all, when interest rates go up, the value of that bond goes down, or that bond portfolio goes down, because there's an inverse relationship between interest rates and changes in the values and prices of bonds or bond portfolios. So this is a really important and straightforward relationship that doesn't require a lot of explanation. So like I'm saying, all of that is also covered in the notes in chapter 9 in the classes I've given you access to. If you get a chance, I talk about that in detail, right? And then lastly, now we are told Now we're actually being asked, okay, fine. You've said that when interest rates go up, the value of portfolio B is going to decrease. You've told us that, right? Now we want you to actually calculate the amount, the value by which the value by which the portfolio amount will go down, like the value by which our portfolio will decrease. Okay, the amount of value by which the portfolio will decrease. How much value will our portfolio B actually lose if interest rates go up by 3.5%? Currently, interest rates are 10%, right? Currently. So let's say interest rates go up by 3.5%. It means that interest rates are going to be 10% plus 3.5%, which is 13.5%. So basically, we're being asked, if interest rates go up to 13.5%, if they increase by 3.5%, how much value is going to be lost from portfolio B? How much value is going to be lost from portfolio B if interest rates go up by 3.5%? Okay. So we simply just have to calculate the price of portfolio B, the value of portfolio B, when interest rates are now 13.5%, right? And then we need to get the difference in price. Remember, we already have the price. Let's say interest rates are 10%. We already have the price of portfolio B when interest rates are 10%. The price of portfolio B when interest rates are 10% is 2482.03. That's the current value of portfolio B when interest rates are 10%. Okay. And then if interest rates go up to 13.5%, we can easily calculate the value of portfolio B. We can simply take our face value, multiply it by our term to maturity times the new interest rate, and then we can get to the new value of portfolio B, right? So if interest rates go up by 3.5%, if this goes up by 3.5% to 13.5%, meaning it's now 0.135, we can simply then calculate the value based on that new interest rate, which is 2015.42. So based on an increase in interest rates of 3.5%, right, to 13.5% from 10%, we are getting the value of portfolio B being equal to 2015.42. So this was the price at 10%, and then the price at 13.5% is now 2015.42. So mathematically, we've shown that when interest rates go up from 10% to 13.5%, we've seen that the price of the bond has gone down from 2482.03 to 2015.42. So we can easily get the decrease in price by just subtracting the current value of the bond at 10% interest rates minus the value of the bond at 13.5% interest rates. And then if we subtract those two, we can see that the decrease in the value of our bond portfolio B is actually 466.61. So this is the change in value, right? So you would have noticed that if interest rates actually went down, you would have an increase in the value of your bond. But whereas in this case, interest rates went up, so we had a decrease in the value of our bond portfolio. And then always be careful when you're entering your values. We're told to use 2 decimal places, and then we'll be done with the first question, right? So it's important to note we're going to see, I think, in assignment 3 and other assignments, and as we do exam prep and exam revision, or as we go on, and also as you go through the chapter 9 classes that I've given you access to, you also need to be able to calculate what we call duration. Duration is an important measure of interest rate risk. I explained earlier what duration is. In this particular assignment, we were not asked to calculate duration, but you need to be familiar with this. And you also need to be familiar with modified duration. I think those are the only things that were not covered in the assignment that you need to be familiar with. But I do talk about them in those classes that I've given you access to. Duration is another approach that you can use to determine the change in the value of a bond portfolio for changes in interest rates. It's another approach, but it builds up on what we've been talking about the value of bonds, but we will cover it later. And I encourage you to also read up on that, okay? So before I move on to question number 2, are there any questions with regards to question number 1? Any questions? I'll give you an opportunity to ask before I move on to question number 2. If you have any questions with regards to anything I've covered so far. Okay, so if there are no questions, I'm now going to move on to question number 2. So like I keep saying, you might find that your question number 2 is slightly different from the question number 2 of other students. So it might be the same. Like I haven't seen a lot of questions so far to be able to compare. You might find that only some of the questions are different, whereas the others are the same, right? So with question number 1, we were talking about and looking at concepts to do with interest rate risk, right? That was in question number 1. Question number 2 now focuses more on issues to do with managing what we call market risk for an individual trader, right? For an individual trader. Remember, we have financial institutions, right? We have financial institutions like banks and insurance companies and so forth, right? And then these organizations like banks, for example, they have to manage market risk. So do insurance companies and a lot of financial institutions. They have to manage market risk. And usually market risk can be managed at the top level where you're managing the market risk or any risk exposures for the whole organization or the whole company, right? But this market risk, it's also important that individual traders within the bank or any financial institution, they also have to be able to manage the market risk associated with the portfolios that they manage for that particular institution. So question number 2, and I think a few other questions in this assignment, they focus on chapter 8, whereby we are looking at how individual traders manage market risk. You see how traders manage market risk within a financial institution. So individual traders within a financial institution like a bank or any other or any investment management company, they also have to be able to manage risks for their own individual portfolios, right? So there are different approaches that these traders will manage risk, and it involves, they make use of what we call Greek measures. They use certain measures for their portfolios that we call Greek measures. We call these measures Greek measures because they have names from the Greek alphabet, like delta. Delta is a certain measure of the risk of a portfolio. So is, let me just put it up here. We have these measures for the risk of a portfolio for an individual trader. We have delta, gamma, vega, theta, rho. So these are certain measures that individual traders can use to help them manage the risk that their portfolios are exposed to. So you might find an individual trader might be told to keep their portfolio delta neutral, gamma neutral, vega neutral, and so forth. So you need to be able to explain what we mean by delta, what we mean by gamma, what we mean by vega, what we mean by theta, and what we mean by rho, right? So it's important to be able to explain what these individual Greek measures mean, right? So for the questions I'm going to be looking at delta and gamma. So I'm going to explain what delta and gamma mean, and then I'll give you some background, like what I did with the first question. And then after that, we'll then work through that first question in the assignment, question 2. And then I think there's also another question here which touches on the Greeks. I think I'll then just move on to question 5 as well. So I'll look at question 2 and 5 after explaining what we mean by delta, gamma, and vega, right? So let me just explain that, okay? So the first measure I just want to explain about is delta. So this is one of the first Greek measures, right? And our prescribed textbook defines delta as the percentage change. Let me see, do they use percentages? I think in the book we actually, let me just confirm. I know other definitions, I just want to keep it consistent. For us in this particular module, we will just, okay, they just say change in the value, they don't choose percentages. So let me just stick to the definition here. So for us, for this particular module, right, we define delta as the change in the value of our portfolio, right, divided by the change in the value of the underlying asset in the portfolio. Okay. Change in the value of our portfolio for a change in the value of the underlying asset in the portfolio. So I just want to explain where this underlying asset is coming from. Everything else there is a bit easier to follow, but when we say underlying asset, it might be a bit confusing. So to explain what we mean by the underlying asset, let me give you an example of a particular portfolio, right? So consider you're a trader working at a particular financial institution and a particular bank, right? Or a particular bank. And let's say you have a gold portfolio, right? In this case, the underlying asset would be gold, right? The underlying asset would be gold. So in this particular portfolio of gold, right? We have gold. When we say spot gold, it means that we actually have gold in our portfolio. And let's say that gold is worth 3,180,000. And then in our portfolio, we also have what we call derivatives. We also have what we call derivatives, right? Derivatives are a special type of financial contract whereby you enter into an agreement with another party and you agree to sell a particular asset to that party for a fixed price sometime in the future. Or you enter into a contract to buy a particular asset from another party for a fixed price in the future, right? So it's an important concept. Like we have what we call forwards, a forward contract, whereby let's say party A agrees with party B. Party A can say to party B that, look, after 9 months, I am legally agreeing to buy 100 kgs of gold from you for, let's say, 9 million rand, right? So these two can enter into an agreement whereby it's a legal obligation that party A agrees to buy from party B a fixed amount of an asset for a certain price at a certain time. So it's a legal contract, even if the price of gold for 100 kgs of gold is different from 9 million after 9 months. Party A will have to honor their contract with party B, right? It's like a contractual agreement. Usually companies or institutions or businesses, they use these types of contracts to help them to manage risk. Like, let's say they want to buy a certain commodity at a certain time and they are afraid prices will be too high. They can enter into an agreement whereby they agree to buy a certain amount of that commodity at a fixed price, regardless of what might be happening in the market. So it can be an agreement to buy or an agreement to sell, right? So we have what we call forward contracts, where it's an informal agreement between two parties. We have what we call futures contracts, where it's a standardized agreement through an exchange. We have what we call swaps. With swaps, you're just agreeing to exchange cash flows based on a predefined contract. We also have options. With an option, you have the choice to buy after 9 months at a certain price, or after a certain duration at a certain price, at a certain term at a certain price, and so forth. And then exotics, these are also kinds of derivatives, but with different with different characteristics. It might combine some forward characteristics, some swap characteristics, some options characteristics, right? So you might find that in particular, for the purposes of what we're doing now, we're not really focusing on what these derivative contracts are, right? We're talking about delta hedging and Greeks and how a trader can manage their portfolio. So we will cover derivatives in other questions, and I also touch on them in the classes that I cover, right? In the same chapter, based on, I think it's chapter 5 of the classes. But now let's focus on what we want to do so that we can finish this. Okay. So we are saying, suppose we want to explain what delta actually means, right? So suppose we have a portfolio where the underlying asset is gold. And then let's say in your portfolio, you have gold worth 3,180,000. Let's say in your portfolio, you've also entered into forward contracts, and the value of the forward contracts that you've entered into with regards to gold are worth 3,060,000, right? So this negative means that you are short. It means that you've entered into a contract whereby you've agreed to sell gold worth 3,060,000 to someone after a certain amount of time. So the negative means you've agreed to actually sell gold at a certain point in time to the value worth 3,060,000. You currently own gold worth this amount, but you've also entered into a forward contract where you've agreed to sell gold at a certain point in the future for this particular amount of money. So this is your portfolio. Let's say in your portfolio, you also have futures contracts on gold. Futures contracts on gold are just like forward contracts, but they are formal. The agreement is made with an exchange, with a financial institution known as the exchange, and there's a clearinghouse involved. Whereas forward contracts are informal. They are between two parties and they are private arrangements, right? So you've entered into a forward contract to sell, hence the negative. You've entered into futures contracts worth 2,000 to buy, hence the positive, right? You've also entered into a swap contract involving gold. So maybe you're exchanging cash flows with another party based on gold. And when you've used valuation methods, which are not part of this module, you don't have to know how to value swaps. When the computer has calculated the value of your swap position in your portfolio, is calculated it to be worth $180,000. You also hold options on gold. So this is a minus again, right? So it means you sold options to someone. You are short on the options. You sold options to do with gold worth a value of 6,110,000. Remember, when we have negatives with regards to any derivative, it means that you are short on that derivative. And then when we have positive values, it means that you are long. In other words, you are sort of like the party who's agreed to buy. The positives mean you're the party who's agreed to buy. Whereas with the negatives, it means that you're the party who is selling, right? And then the value of your exotic options is actually 125,000. So we can add all of these values up And then we can see that you actually have a negative value of minus 5683000 on your gold portfolio, right? So this is the current value of your gold portfolio in total. If we look at your total position here, right, you have a negative value in your gold portfolio, right? So the concept behind delta neutrality, right? When we say that you want to make your portfolio delta neutral, basically what we are saying that you don't want the value of this portfolio to be affected by a change in the spot price of gold. That's what delta neutrality is. We've said that delta is a measure of the change in the value of the portfolio. How does this amount change when the price of gold changes? You might find that, here's a perfect example. You might find that if there's a small increase in the price of gold, let's say gold is currently at 1,300 per ounce, you might find that if the price of gold increases by a small amount from $1,300 maybe to $1,310 per ounce, that can have a negative effect on the total value of your portfolio. You might find that if there's a 10-cent increase in the value of gold, in the price of gold, you might find that the value of your portfolio will go down from minus 5,683,000 to minus 5,683,100. So it means that your portfolio is sensitive to changes in the price of gold, right? And then that sensitivity, the measure of that change, can be measured by what we call the delta of the portfolio. It's measured by what we call the delta of the portfolio. So in this particular case, we would take the change in the value of our portfolio. We can see that our portfolio has had a decrease in value of 100 divided by the change in the spot price of gold, which was 10 cents. So we simply divide change in the value of our portfolio, which is minus 100, divided by change in the spot price of gold, which is 10 cents, an increase of 10 cents. So we put that as a positive, a decrease in the value. So we put that as a negative. And then if we divide those two, we get our delta. So the delta of a portfolio simply tells us, it's simply a measure of the change in the value of a portfolio divided by the change in the price of the underlying assets of a portfolio. So that's the delta. So when it comes to delta neutrality, we might want to make sure that we might want to create a portfolio such that if the price of the underlying asset goes up or goes down, right? Here we've seen that there's been a 10% increase in the price of the underlying asset. We might want to create a portfolio such that if the price of the underlying asset goes up or goes down, the value of our portfolio remains the same, right? Such that we might want to create a portfolio such that if there's a 10-cent increase from 1,300 per ounce in the price of gold to 1,300.10, right, per ounce, we might want to create a portfolio such that the value of our portfolio before will just be the same as the value of our portfolio after. In other words, we might want to create a portfolio which will not have a change in value for small changes in prices of the underlying asset. And when we create a portfolio like that, we say that we've created a delta neutral portfolio, right? We call that a delta neutral portfolio. And traders will try to create a delta neutral portfolio such that they will not be exposed to movements in the underlying asset, especially when they have a portfolio that contains these contracts that we call derivatives. So when we talk about delta neutrality, like we're going to see in this particular question, that's what we are referring to. So delta, the first thing you need to note before we look at question 2, delta is simply the change in the value of a portfolio, usually a portfolio with derivatives, divided by the change in the value of the underlying asset. And then when we say we've created a delta neutral portfolio, basically we are saying we've created a portfolio that will not change in value for small changes in the price of the underlying asset. Okay, so that's delta. And then closely related to delta is gamma. Closely related to delta is gamma, right? So we can define gamma as follows. Gamma is closely related to delta, and we can define gamma as follows. I just like to refer to this just to make it easier for you to follow. We can define gamma as this, right? Gamma can be defined as the rate of change of the portfolio's delta with respect to changes in the price of the underlying asset, right? Delta, change in value of portfolio for changes in the value of the underlying asset. And then gamma, gamma is the change in the value of delta. How is our delta changing when the value of our asset changes for change in value of underlying asset? So let me explain why this is important before we look at our particular question, right? So we now know what delta neutrality is. We now know what delta neutrality is, right? Delta neutrality means that for small changes in the value of the underlying, right? Small changes in the value of the underlying, our portfolio will not change value. That's what delta neutrality is telling us. Delta neutrality is telling us that we can create a portfolio such that when prices of the underlying change by a small amount, the value of our portfolio will not change. However, delta neutrality has limitations. Delta neutrality has limitations. In that, if we have large changes in price, right, the delta of our portfolio will change. If you have large changes in price, delta neutrality will not help because the delta of your portfolio will change, which means that your delta neutrality will be affected. So you saw in this particular example that we looked at, whereby we had a small change of 10 cents in the price of gold, right? And we explained that we can calculate our delta and we can prevent this negative effect on our portfolio value by creating a portfolio that's delta neutral, right? However, for large changes, let's say the value of gold increases by a large amount, like let's say $200, right? Delta neutrality alone is not going to protect the value of our portfolio from not falling. Delta neutrality will not help us. Like we will need to also create a portfolio that's gamma neutral. In other words, we'll need to create a portfolio such that for large changes in the price of the underlying asset, the delta will not change. So in other words, we are saying for small changes in the price of the underlying asset, the delta does not change. And we can create a delta neutral portfolio such that for small changes in the price of that underlying asset, the value of our whole portfolio will not change. However, for large changes, for example, a $200 change in the price of gold per ounce, for large changes in the price of the underlying asset, our delta will change. It won't remain the same. And that means we will not be able to make our portfolio delta neutral. We have to go a step further and we have to make sure that the delta will also not change for large changes in the price of the underlying asset. And that's when we make the portfolio what we call gamma neutral. Remember, gamma neutral is a measure of the change in delta for changes in prices of the underlying asset. So when your portfolio is gamma neutral, it means that your delta is not changing. And when your portfolio is delta neutral, it means that the value of your portfolio is not changing for small changes in prices of the underlying. So I know that these Greeks can be a bit confusing. So I just wanted to give you some background before we answer this particular question so that it makes sense. Okay. So now that we have some background with regards to what we actually mean by delta, what we mean by gamma, what we mean by gamma neutrality, and what we mean by delta neutrality, now we can answer a question like this. And it's not just about doing the calculation, but it's also about understanding it in case it comes in the exam and it's been slightly changed. Okay, so now let's see if we can answer question 2 now that we have some background and we can understand what this question is actually saying. So the question is saying that we've got a trader's portfolio, which is delta neutral. So we now know what this means. It means that small changes in the price of the underlying asset will not affect the value of the portfolio, right? And then we've also been told that the gamma of the portfolio is -4,250. And we also know what this means. This means that for small changes, this means that for changes in the price of the underlying asset, our delta will change by -4,250. Remember, gamma is the change in delta for changes in the underlying asset price. So we are being told that if there is an increase, a small increase in the price of the underlying, in fact, let's just say if there's an increase, remember, because gamma also accounts for large increases in price. So we're being told that if there's an increase, right, a unit increase in the price of the underlying asset, our delta is going to go down. There's a negative there, meaning there's an inverse relationship. If there's a small if there's an increase in the price of the underlying, our delta is going to go down by -4,250. For a unit increase in the price of the underlying, our delta is going to go down by -4,250. For a unit decrease in the price of the underlying, our delta is going to go up. So it will go in an opposite direction because of the negative. So gamma is just telling us how the delta will change for a unit increase or decrease in the price of the underlying. Okay. So we've been told what our gamma is. So our portfolio is not gamma neutral, it's delta neutral, but it's not gamma neutral, meaning that changes in the price of the underlying asset will change the delta of the portfolio. So the delta and gamma of the particular trade for a particular traded call option are 0.62 and 1.52 respectively. So a call option is just a type of a derivative. So we're just given the delta and gamma for this particular option, right? So this particular option can help us to make our portfolio gamma neutral as well as delta neutral. So far I've explained what a delta neutral portfolio is. And I've explained what a gamma neutral portfolio is. And I've also explained what delta is, right? And I've also explained what gamma is. Delta is the change in the value of the portfolio for a change in the value of the underlying asset. Gamma is the change in the value of the delta for a change in the value of the underlying asset. I've explained both of those. I've explained that a delta neutral portfolio is a portfolio such that small changes in the price of the underlying asset will not affect the value of our portfolio. I've explained that a gamma neutral portfolio is a portfolio such that changes in the price of the underlying asset will not affect our delta, like our delta will remain the same. But so far, I haven't actually explained how to make a portfolio gamma neutral and how to make it delta neutral. So I now want to talk about that, okay? So suppose we have a portfolio that has a gamma of -4,250. How do we make this portfolio gamma neutral? Right? We can make this portfolio gamma neutral using options, in this case using call options. If your portfolio has a negative gamma of 4250, right? You just have to hold, you have to hold another asset with a gamma of plus 4250 to make your portfolio gamma neutral. Our portfolio has a gamma of minus 4250, right? So if we want to make our portfolio gamma neutral, we just have to find some other asset, whether it's a derivative or any other type of asset. We just have to somehow find another type of asset which has a positive gamma of 4250, and then we need to put that asset into our portfolio such that our portfolio becomes gamma neutral, because these two will balance each other out, right? So in this case, we want to use these options. So one particular option, one particular call option has a gamma of 1.52. So it means if we want the total gamma to be equal to 4250, we have to hold a certain number of options such that the total gamma for all those options will give us plus 4250. Okay, so in this particular case, the gamma of one option is plus 1.52, right? So we can take the gamma of our portfolio, which is 4250, and then we can divide it by the gamma of one particular call option, and then we can get 2796, right? So in other words, if we purchase 2,796, if we purchase 2,796 call options, and each of those has a positive gamma of 1.52, the total gamma from those 2,796 options, where one of them has a gamma of 1.52, will give us 4250, approximately. So in other words, if we purchase 2,796 call options, each of those call options with a gamma of 1.52, right? We will get positive 4,250 gamma from those options that we've purchased. And then this positive gamma will then offset this negative gamma already in our portfolio, and then that will make our portfolio gamma neutral. And then the negative that we have here will need to be offset by a positive here. And remember, we said that a positive on a derivative, in this case, a positive on the gamma for the derivative, means that we need to take a long position in 2,796 traded options, such that our portfolio will be gamma neutral. So what will happen here is that currently our portfolio has a negative gamma of 4250. So what we will do, we will purchase 2,796 options, each with a gamma of 1.52, to give us a total gamma of plus 4250, right? And then by purchasing these call options, we will offset this negative gamma, and then that will make our portfolio gamma neutral. And then the positive value on this gamma will mean that we have to purchase the call option. So we need to go long on the options such that our portfolio becomes gamma neutral. If we had had a positive value on the current gamma in our portfolio, and we wanted to make it gamma neutral, we would also have to have a negative value such that the net effect is 0. And then that would mean that we would have to take a short position. When we're dealing with gamma and delta, when we have a negative value in the delta or gamma we calculate, it means that we are taking a short position to make our portfolio delta or gamma neutral. And then if we have a positive value in the delta or gamma that we calculate, it means we are taking a long position to make our portfolio delta or gamma neutral. Okay. So in this case, by adding 2,796 traded options, we will end up with a gamma neutral portfolio, right? So that's the first part that we were asked. We were asked, how can we make this portfolio gamma neutral, right? And then by adding those options, by adding those 2,796 options, we're also going to create another problem. So we've made the portfolio delta neutral, gamma neutral, fine, but we've also created another problem because we've now affected our delta neutrality. We've added a new derivative contract to our portfolio, 2,796 options. So that's going to affect our delta neutrality, right? So currently, our portfolio is delta neutral, right? Currently, our portfolio is delta neutral. However, we've now added 2,796 options into our portfolio, and each of those options has a delta of 0.62. So we've now created a problem. We've added a new asset into our portfolio, and as a result of adding that new asset, which is the call options, we've affected our delta. So we've now increased our delta to 1,733.52. So our portfolio is no longer delta neutral. Initially, our portfolio had a delta of 0. Then we added some options to try to make the portfolio gamma neutral. So our portfolio is now gamma neutral. But by adding those portfolios, we've now increased the delta to 1,733.52. So remember, we want our portfolio to be both gamma neutral. We want our portfolio to be both gamma neutral as well as delta neutral, right? So we have to do something about this change in delta such that to maintain the delta neutrality of our portfolio. So when it comes to the delta, to make our portfolio delta neutral, we simply have to, so remember, this is the new delta, right, of our portfolio. The delta of our portfolio is now positive. So to balance this delta out, we will need to go negative, right? Such that this plus this will give us 0. So it means we need to go short. We need to go short on a particular asset such that we can maintain delta neutrality. And then to maintain delta neutrality, we just have to go short on the number of shares associated with our new delta. So we finish off by saying, hence, in addition to the 2,796 traded options, which helped us to get to gamma neutrality, we will also need a short position. In other words, we will also need to get minus 1733.52 with regards to our delta. We will need to take a short position in 1,734 shares such that we maintain that delta neutrality we had at the beginning. So in other words, because of the addition of these options to make us gamma neutral, we've increased our delta to 1,733.52. And then to return our portfolio back to delta neutrality, we will need to hold assets or derivatives which have a delta of minus 173.52. And then we can simply get this delta back by going short 1,734 shares. So when it comes to delta neutrality, it's a bit easier. If you want to be negative with regards to delta neutrality, you just take a short position in the particular shares of the underlying, or you just go short in the particular asset of the underlying with respect to the delta. And then if we had a negative delta and we wanted to make our portfolio delta neutral, we would just go long on the particular share or the particular asset that we're dealing with. So in this case, because our delta has gone up to 1733.52, we would just have to take a short position with regards to our underlying asset such that we then maintain that delta neutrality we had at the beginning. Okay. So that's question 2. There's a lot of the Greek measures are the trickier part with regards to this module, but they tend to just deal on the same types of concepts which are important to master and understand through assignment questions and past exam questions, right? So remember, when we also talk about going short, it means you're selling, right? You're selling certain units in the underlying. And then when we talk about going long, you're actually buying. So these are some concepts I talk about in the classes on chapter 5. So it's important to have a good understanding of chapter 5 before you look at chapter 8, because in chapter 5, we talk about what derivatives are. We talk about what it means to go long, what it means to go short. This is all important. We also talk about what forwards are, what futures are, what options are, and what swaps are. So this is all important. So you need to be familiar with some of these concepts before you can understand delta neutrality and gamma neutrality, and how to make your portfolio gamma neutral, and also how to make your portfolio delta neutral, and so forth. Okay, so now having covered question 2, some of you might have some questions you want to ask. I'll just give you a few minutes if there are any questions. Does anyone have any questions they want to ask there? Okay, so there are no questions. Okay, so let's finish off today's session by looking at one last question to do with the Greeks. The last question to do with Greek measures. Let me see. There were 2 questions here, 1 or 2 other questions that have to do with Greek measures. We can see if we can look at one of them or both of them. We have question 5. And then we also have question 6. I think I'll start with question 6, because question 6 is still dealing, okay, this one is also dealing with gamma and vega. And then this question is dealing with delta, gamma, and vega. Okay, so let me start by introducing vega, right? We now know what delta is. We're now hopefully very comfortable with what delta is. The delta of a portfolio of an asset, it just tells us the change in the value of that asset or that portfolio for a change in the price of the underlying. So we can even talk about delta or gamma with respect to an option. An option is just a type of asset, and then its value can change for changes in value of the underlying asset. The option is based on whether it be gold, a share, oil, or any commodity or so forth. So we now know what delta is. We know what gamma is. Gamma is the change in delta for changes in value of the underlying. But now we have a new Greek measure. So this is the 3rd Greek measure we're going to talk about. We also have a Greek measure which is known as vega. Vega. So there are a number of Greek measures, like we said, right? We have a number of Greek measures. We actually have 5 Greek measures you need to know about. You need to know about delta. We've talked about that. You need to know about gamma. We've talked about that. You also need to know about vega. Then we also have theta and rho. So I now just want to briefly introduce you to vega before we look at question 5. Okay. And then based on our prescribed textbook, I just want to use the definitions here so that you won't be confused when you are going through this. We can define vega as follows. Vega can be defined as the change in the value of our portfolio divided by the change in the volatility. Change in the value of our portfolio divided by the change in the volatility. In other words, vega tells us the amount by which the value of our portfolio will change for a percentage change in volatility. Okay, so it's the rate of change in the value of our portfolio with respect to changes in volatility. So let me explain what that means, right? So when we talk about volatility, volatility is just, it's a measure of how frequently the value of our asset changes and by how much the value of our asset changes, right? So for example, let's say we measure the price of our asset over 5 days. Let's say we have an underlying asset and we measure the price of our asset over 5 days, right? Let's say on day 1, the price of our asset is 100 Rand, day 2, 120 Rand, day 3, 70 Rand, day 4, 200 Rand, and then day 5, let's say it's 80 Rand. This one, let me even make it, maybe 300 Rand. Let's say we have something like this, right? And then, so this is asset A. Let's say we have asset B, day 1, day 2, day 3, day 4, day 5. Let's say asset B at a price of 100 Rand on day 1, 105 Rand on day 2, end of day 2. Let's say end of day 3, 108 Rand, end of day 4, 102 Rand, end of day 5, 98 Rand, right? So this is asset B, this is asset A. If we compare these two assets, right, we say that asset A is more volatile compared to asset B. Asset B is less volatile. Sorry, that's L, volatile. Volatile. Okay. Why do we say that? If you look at asset A, the prices of asset A seem to change a lot every day. We start with asset A at a price of 1. After day 2, the price goes up to 300. After day 3, the price goes down to 70. Day 4, the price goes up to 200. Day 5, the price goes down to 80. So we can see massive changes in price each day. So we call that volatility, right? The price is very volatile. It can go up a lot, it can go down a lot. It's very unpredictable and it goes up by large amounts. Compare that with asset B. With asset B, we only have moderate changes each day, 100 to 105 to 108 to 102 to 98. These are very small changes each day. So asset B is a bit predictable in terms of its price. So asset B is less volatile. It's got less volatility. So when we talk about volatility, we're just talking about how frequently the prices of an asset change and the magnitude of that change. Are they small changes or are they large changes, right? So if you find that an asset changes prices a lot, like over the course of a year or a month, and the changes in price are massive, we say that that asset is volatile. And then if an asset doesn't change prices a lot and the changes are not significant, we say that it's not volatile, right? So volatility can affect the value of a portfolio, especially if you hold derivatives, right? If you have an asset that is very volatile, it's going to affect the value of your portfolio significantly. And if you have an asset that is not very volatile, it will not affect the value of your portfolio significantly. So we can measure the change in the value of a portfolio for changes in volatility using a measure known as Vega. So Vega measures how our portfolio will change in value for changes in volatility, okay? So there are also chapters that talk about how to measure volatility. I think that will come up in assignment 3, how we actually measure volatility and the different approaches to measuring volatility. So we're going to cover that. But I just wanted to explain to you what Vega means. So basically, this value of Vega of minus 4.485 is telling us for a unit change in volatility, the value of our portfolio is going to change by 4.485, right? So of course, the negative means that if our volatility goes up, let's say by 1%, then the value of our portfolio will fall by minus 4.485. That's the negative. It means an inverse relationship. And if our volatility goes down, let's say by a unit, the value of our portfolio will go up by 4.485 based on Vega. So Vega is telling us how the value of our portfolio will change based by changes in the volatility of the underlying asset. So let's go again. Let's see if we can answer some of these questions with regards to question 5. Things should be coming a bit familiar to you now with regards to these Greek measures. So we're told the financial institution has the following portfolio of over-the-counter Canadian dollars. So this particular company, right, it's got a portfolio, right? And in this portfolio, they are just holding derivatives. They're holding derivatives, right? And the derivatives they have some call options, put options, and call options. They've got a short position in 1,100 call options. They have a short position in 550 call options. They've got a short position in 2,100 put options, and they've got a short position in 550 call options, right? And then we're given the delta of each of the options. The delta of these options is 0.55. Delta of these options, each one is 0.82, these put options. So we're also given the deltas of each of these options, and we're given the gammas of each of, and we're also given the vega. Delta telling us how the value of this particular option will change for small changes in the price of the underlying. Gamma telling us how the delta of each of these options will change for changes in the price of the underlying. Vega telling us how the value of each of these options will change for a unit change in the volatility of the underlying, okay? So the delta of the portfolio, the total delta of the portfolio has been calculated for us already. It's minus 453.50. But if you want to calculate that, you can just say this times this, position times the delta per option, position times the delta, position times the delta. Then you can say this times this plus, minus 550 times 0.82 plus, minus 2,100 minus 0.43 plus, minus 550 times 0.71. You will get this answer, but they've already done that for you. I'm just explaining, you might be asked, calculate the delta of the portfolio. That's how you would do it. We've also been given the gamma of the portfolio. Again, for the gamma of the portfolio, you would just say the position times the gamma of that particular portfolio plus position times the gamma of that particular portfolio option plus the position times the gamma of that particular option plus, and then if you add those up, you would get the same answer. They've given that to you already. The same would apply with the vega. There've been assignment questions and exam questions where you've been asked calculate the vega. It would just be this times this plus this times this plus this times this plus this times this. Okay. But they've already done that for you. Okay. So the first question is, we're being asked, what position should the investor take to make the portfolio gamma neutral? What position should the investor take to make the portfolio gamma neutral? Okay, so our portfolio has a negative gamma, right? So we know to make our portfolio gamma neutral, we will need to add the assets to the portfolio that have a positive gamma of 6370, right? And we know when we've done this, the value, when we've done this, it means that for changes in the price of the underlying, our delta will not change. Remember, gamma is a change in the value of delta for changes in the price of the underlying, right? So currently our gamma is minus 6,370. So we need to add assets into our portfolio or derivatives, which have a total gamma of plus 6,370, such that our portfolio will have a net gamma of 0 and our portfolio will be gamma neutral, right? So because we have to add an asset with a positive gamma, it means whatever we're going to add into the portfolio, we need to go long. We need to go long. And in this case, we need to add options. So we need to go long on those options. Remember, we said if we calculate the change in our gamma or in our delta such that the change we have to make is positive, it means we need to go long in the asset or we need to go long in the derivative that we're going to add into our portfolio to ensure gamma neutrality or delta neutrality. So in this case, because our gamma is already negative, and we need to add assets with a positive gamma such that we have gamma neutrality, it means that we have to go long in the asset that we're going to add. In this case, the asset would be traded options. So we will need to go long in total to 6370 plus 6370, such that when we add this particular derivative or asset into our portfolio, it will offset this negative gamma and our portfolio will be gamma neutral. So we need to take a long position in the traded options to make our portfolio gamma neutral. And then someone might ask, how many options do we actually need to add to make our portfolio gamma neutral? So currently, our gamma is minus 6370. We want to make it positive 6370. So we're going to add options, right? And then we've been told that we have an option available, which has a gamma of 1.82 per option. So the number of options we will need to go long by is 6370, which is the total gamma we're trying to get, divided by the gamma of a particular option. And then if we divide these two, we will get roughly 3,500. So what we need to do to make our portfolio gamma neutral, we need to go long 3,500 options. Each of those options is going to have a gamma of 1.82, and then that will give us 6370 as our new gamma that we will add to our portfolio where the gamma is already 6370, and then this is positive, it will offset this negative, and then that will make our portfolio gamma neutral. We already looked at this in question 2, so this should now be a bit easier to follow, right? And then we'll come across that problem again. Now we've added 3,500 options into our portfolio. Our portfolio is now gamma neutral. However, these 3,500 options we've added into our portfolio are going to create a problem. They're going to increase our delta. And remember, we want our portfolio to be both gamma neutral and delta neutral. They're going to increase our delta. So this is a problem. Our portfolio was, we want our portfolio to be delta neutral. So these options are going to increase our delta, right? Currently our delta is minus 543.50. But now by putting in these 3,500 options, it's going to increase our delta. So that's going to create a problem. So the delta of the whole portfolio, including the traded options, is going to go up. Currently, it's minus 543.50. But then including these traded options is going to increase the delta. So the delta of the portfolio is now going to be 1,556.50. And then it's going to be a positive delta. So we're now going to have a problem here. Our delta is going to increase significantly. So we might then want to make our portfolio delta neutral. And to make our portfolio delta neutral, it means we need to add an asset or a derivative into our portfolio such that that asset or derivative has a delta of minus 1,556.50, such that it cancels out this positive delta, and then we have a negative delta. And remember that for delta neutrality, we just have to hold the underlying asset, a certain number of the underlying asset. In this case, because we need to get a negative delta, it means we will need to go short on the underlying asset. So in this case, where the underlying asset is Canadian dollars, so the amount of Canadian dollars that will be required to make the portfolio both gamma and delta neutral will actually be 1,556.50. And this question had a mistake, like the answer was already there. So you couldn't fill it in. Like, I don't know, I think it was a problem with the system. But for the question, you might actually have to do the calculation. whereby you calculate your delta in this particular case, and you get the new delta of the portfolio, and then we get a positive answer there. And then we want to make our portfolio delta neutral. So because we get a positive answer there, it means that we need to add an asset into our portfolio with a negative delta of 1556.50, right? And then this will just be the underlying asset, and then the negative will mean that we have to go short on that underlying asset, and then it will offset the delta that we already have on the asset in this case, which is 1556.57. So the question was meant to be a bit similar to question number 2, but the problem is, I think there was a problem with the system, but it's the same idea. Calculates the number of options you need to make your portfolio gamma neutral. Those options will upset your delta, and your delta will now increase. And then you need to hold a certain number of the underlying asset, whether shares or currency, in this case, Canadian dollars, to make your portfolio delta neutral again. So for some of you, the system might have fixed it, but when I assisted the student with this, when I did these solutions, sorry, the system had a mistake there. And then finally, we can finish off with question 6, which is the last question on the Greeks. So it means we will have covered question 1, 2, 5, and 6. I'm just going to finish off with question 6. Is a bit easy in terms of the concepts now, because we now understand what gamma is, what vega is, what delta neutrality is. So we won't take too much time here. But before I go on question 6, I'm not sure if there's any questions with regards to question 5. I'll just give you an opportunity if anyone has any questions here. Okay, so if there are no questions with regards to question 5, let's finish off the session by looking at question 6. So the gamma and vega of a delta neutral portfolio are 60 and 31 respectively, right? So we know what gamma is, we know what vega is, we know what delta neutrality is, where vega is per percentage, okay? So vega is actually the percentage change. They said it's in percentages. So in this case, it's actually the percentage change in the value of our portfolio for a change in our volatility, for a unit change in our volatility. So estimate what happens to the value of the portfolio when there is a shock to the market, causing the underlying asset price to decrease by 5 and its volatility to increase by 6%. Okay, so we know that changes in the price of the underlying are going to affect the value of our portfolio. We've already talked about that, right? But we've said that if our portfolio is delta neutral, it means that small changes in the price of our asset will not affect the value of our portfolio. However, small changes in the price of the asset will affect our gamma, which means our delta will be affected, right? Volatility is also increasing. So volatility, we know that changes in volatility can change the value of our portfolio, and we can measure that change using vega. So in this case, we've actually been given the gamma measure. Gamma, remember, measures the change in the value of our delta for changes in the prices of the underlying. And then vega measures the change in the value. Vega measures the change in the value of our portfolio for changes in volatility. So in this case, our portfolio is delta neutral. So we're assuming that small changes in the price of the underlying are not going to affect the value of our portfolio, right? Small changes in the value of the underlying are not going to affect the value of our portfolio based on delta. However, this change in the value of the underlying is going to affect our delta. Our delta is going to change based on the gamma value that we have. And also this change of 6% in volatility is going to affect the value of our portfolio based on the vega value that we have. So we want to actually calculate what the change in the value of the portfolio will be. Okay. So first of all, we are asked, what will happen to the value of the portfolio if there is a decrease of $5? to the price of the underlying, and if volatility increases by 6%. So here we say the value of the portfolio will increase if there's a shock to the market that will cause the underlying price of the asset to decrease by $5 and volatility to increase by 6%. Okay, so there's some important theory you need to know here, right? There's a direct relationship. Between the value of an asset. In fact, between the value of a derivative. There's a direct relationship between the value of a portfolio. Let me just say the value of a portfolio or a derivative, especially derivative. There's a direct relationship between the value of a portfolio which of course will include derivatives. There's a direct relationship between the value of a portfolio, a derivative, or an asset, and volatility. Whenever volatility goes up, the value of a derivative or a portfolio which contains derivatives will also go up. Okay, I'll repeat that. Whenever volatility goes up, the value of a portfolio or a portfolio with derivatives, the value of that portfolio will also go up. There's a direct relationship between volatility and the value of a portfolio which has derivatives. In this case, we're looking at delta and gamma. We're talking about portfolios which have derivatives, right? So there's a direct relationship between volatility and the value of a portfolio, right? Likewise, when volatility goes down, when there's a decrease in volatility, the value of a portfolio which holds derivatives and so forth will also go down. So there's a direct relationship between volatility and the value of a portfolio, in this case, a portfolio of derivatives. So the value of our portfolio will increase because there's been an increase in volatility. However, if we had been told that there's been a decrease in volatility negatively affects the value of a portfolio, in this case, portfolios with derivatives, so there would be a decrease there. So there's something important you also need to be familiar with regards to those relationships. In chapter 8, it's really, really important. Let me just see. You need to be important. You need to understand how different measures affect the value of a portfolio with derivatives. I'm sure we will cover that later on, especially when we look at these examples. I think in further assignments, we will cover that. I'm sure they talk about it in chapter 8, but we will cover it later. There are certain things that you need to know. For example, how does time affect the value of a portfolio with derivatives? How does volatility affect the value of a portfolio with derivatives? How does the risk-free rate? All of those measures, but we will look at that later. For now, I just understand that important relationship between volatility and the value of a portfolio with derivatives, right? And then lastly, we're actually asked to determine the value of the change. What will be the value of the change in the portfolio when there's a decrease of $5 in the price of an underlying and the volatility increases by 6%? So to actually do this calculation, there's an important formula you can use. The formula is given right here, right? So to calculate the increase in the value of the portfolio, you just say 1/2 times your gamma multiplied by the change in the value of the underlying squared plus the vega multiplied by the change in the volatility. So you can do this particular calculation and then you can get 936, right? So it's just a matter of substituting. So something important to note here is that the increase in value, like we said, when volatility goes up, this part has to do with vega and volatility. When volatility goes up, it's got a positive effect on the value of our portfolio. However, let's say our volatility had gone down, it would have a negative effect on the value of our portfolio. So that's also important. Whereas the change with regards to the change in the price of the asset is just dependent on the gamma and the change in the price of the asset and so forth, right? So a negative gamma here would have had a negative effect on the value of the portfolio, right? Okay, I think we are done. Are there any questions with regards to the concepts covered in the class? 2 hours is a bit long, so I know concentration levels can start going down a bit at the end of the lesson. Just a summary of what we've covered. We've covered question 1, interest rate risk, background, how to value bonds and bond portfolios. We've covered question 2 on delta neutrality and gamma neutrality. We've also covered question 5 and question 6 to do with delta neutrality, gamma neutrality, and also the effects of vega, right? So as we finish, I'm not sure if there are any questions with regards to anything covered there. Anything you want to ask, I'll give you an opportunity if you have any questions. Okay, so if there are no questions, I think we can end there. Just one important point before we finish. I just want to explain something here, right? The increase in the value of the portfolio. I think in this case, right, we were able to say that there's an increase in the value of the portfolio because of 2 things, and it's something we shouldn't overlook. Firstly, because the volatility was going up, right? So we say that the value of the portfolio will increase. And then another factor that's also contributing to the volatility of the portfolio increasing is that the gamma is positive. The gamma is positive. If the gamma had been negative, right? If the gamma had been negative, we were going to end up with something like this, where it would be half minus 60 times 25, which is 5 squared, which would be minus 30 times 25. Let me just calculate that quickly. Okay, minus 30 times 25. This would actually be minus 750. And then 31 times 6. And then you see this would be 186. Sorry, 186. So now this is important. If our gamma had been negative, it wouldn't be as clear cut as to just say volatility is increasing, therefore the value of the portfolio is increasing. In this case, we were able to say that the value of the portfolio is increasing because both the gamma and the change in volatility were positive. So we could confidently say that the portfolio is increasing in value. However, if you have a negative gamma and an increase in volatility, you actually just have to calculate it first to see what the change in the portfolio value will be. And then based on that solution that you get, if it's a negative, then you can say the value of the portfolio will decrease. And then if the answer is a positive, then you can say that the value of the portfolio will increase. So that's important. Let's not just look at volatility exclusively, also consider your gamma and how your gamma value is changing. And even the vega value as well. So you also need to, once they start becoming negative, it's not a matter of just saying volatility is increasing or decreasing, so the portfolio is increasing or decreasing, but you actually have to do the calculation. Okay, so that's important. However, it is important to note that volatility on a standalone basis does increase the value of a portfolio with derivatives. Okay. So thank you very much for listening. I